Alright, in this video, there are two files you need to get. You could just do it with one file. You could just get the Excel file. But there's a PDF, and that's the PDF we're looking at right now, which is a good PDF to print out so that we can one more time review how to fill out cost tables, what these costs mean. And we're going to graph our marginal cost after we finish filling in these blanks. And then we're going to practice figuring out what the market supply curve looks like. So we're going to be assuming that we're given the demand curve, and we're going to draw the market supply curve, assuming that there are 100 perfectly competitive firms in the market. And after we get done doing this bit by hand, we're going to switch over into an Excel file, which also has this page in it. So you could just download the Excel file and print this page out, or fill it out any way that you like. But we're going to look at an Excel file where we can do some simulations. And by simulations, I mean we're going to take whatever results we get here about whatever the market price is for these 100 perfectly competitive firms, and we're going to determine, are these 100 perfectly competitive firms making a profit, breaking even, or losing money? And if they're either making a profit or losing money, we're going to explore what needs to change in the long run. Are more firms going to enter if they're making a profit? Or are firms going to exit this industry if they're losing money? And approximately how many firms might need to exit to bring us to that long run break-even price, where all the firms are just covering their costs, including the normal profit, of course. So make sure you've downloaded those two files so that you can play around with them. Just watching, it's okay, but you're only going to learn about half as much as if you do it along with me. So let's dive right into the manual part here. Here we have a cost table. And as usual, what you're going to be given in the real world are just the first two columns, and it's going to be your job to fill out the rest of the table. But I filled out a lot of it so that we don't have to do all the drudgery every single time. But make sure you know how to do this. So the first step, as always, is to figure out what the TFC, or total fixed costs, are. And the total fixed costs are always going to be found right here. How much are our total costs when we're producing zero? Because when we are producing no units, we can't be using any variable costs. Variable costs are the things we use more of when we produce more units. When we're not producing any units, we're not using anything that we're going to call a variable cost. Here, when we're producing zero, all of those total costs, $640, are fixed costs, and the variable costs are zero. So we already looked at this cost table once before in a previous video, but that's fine. This is a good reminder to work through this one more time. And we'll work through an example with a totally different cost table at a couple times in the future. So the fixed costs, since they don't go up, they're always $640. And of course, when we say they don't go up, that doesn't mean they can't go up later on in a few months or in a few years. We mean they don't increase today as we produce more units. In the long run, they could go down, they could go up, but always $640, at least today. And that, of course, means that if we shut down, which means we produce 0 units today, we're still going to have to pay that $640. Now, variable costs, we can always get by total cost minus fixed cost equals variable cost. So 1,040 minus 640 is 400. Filling in this one down here for 7 units. When we're producing 7 units, our total costs are 2,240. Our fixed costs are 640. 2,240 minus 640, $1,600 in variable costs. And when we're producing 10 units, our total costs are 3,880. 640 of those are the fixed costs. 3,880 minus 640 leaves us with $3,240 in things like labor and materials, whatever we use more of, and costs us more as we produce more units. Now here are the 3 average columns: average fixed cost, average variable, and average total. When we say average, we mean divide by the quantity. However, for fixed costs, when we take 640 and divide by 0, we can't do that, so we just say not applicable. Average variable cost would be 0 divided by 0. We can't do that either. And average total cost, 640 divided by 0. We can't do that either. But for all the other averages, we just take that cost, whatever it is, fixed cost, divide it by quantity. So here 640 divided by 1 tells us that we're spending $640 per unit in fixed costs. Variable costs, average variable cost, 400 divided by 1. We're spending $400 per unit in labor and materials, or variable kinds of costs. And average total cost we can either get by 1,040 divided by 1 or 640 plus 400. Average fixed plus average variable equals average total. You get $1,040 per unit in total costs either way. When we're making 7 units, we have average fixed cost will be 640 divided by 7, and 640 divided by 7, $91.43. Average variable cost when we're producing 7 units would be this $1,600 in variable costs divided by 7, and that gives us about $228.57. Average total cost when we're producing 7 units, 2,240 divided by the 7 units, tells us that we're spending about $320 per unit for all of our costs. And then when we're producing 10 units, fixed costs, 640 divided by 10 is going to be $64 per unit in those fixed costs. 3,240 divided by 10 is going to be $324 in variable costs per unit. And taking our total cost divided by 10, we're just moving the decimal place one time, and we get $388 per unit for all of our costs. Which leaves us with the marginal cost column. How much additional cost are we spending when we produce each additional unit? In other words, how much does each of these units actually cost when we produce it? Now, marginal cost for the 0 unit doesn't make any sense, so we don't do that. But marginal cost of the first unit is the additional cost going from 640 to 1,040. It's a change in the total cost. Or we could look at the change in the variable cost, because they're always going to be changing by the same amount. So $400 is the marginal cost of the first unit. When we produce it, it costs us $400 more. That's how much it costs to produce the first unit. Now, skipping along to the 7th unit, the additional cost is either $2,240 minus $1,960 or $1,600 minus $1,320. Got to get the same answer either way. Looks like it's $280. And the marginal cost of the 10th unit, $3,880 minus $3,200 or $3,240 minus $2,560. That last 10th unit costs $680 to produce. All right, let's graph the marginal cost. I graphed the other 2 cost curves that we normally graph here, average total and average variable. And those are always going to look kind of like a U shape. The difference between the average total, the red looking curve here, and the blue average variable, the difference between those two is the average fixed cost. And that's why we see the curves getting closer and closer and closer as we produce more units, because that average fixed cost is getting smaller and smaller and smaller as we produce more units. All right, let's graph those marginal costs very quickly. I'll use green here. The first unit costs $400 to produce. The second one, $240. Okay, just below $250 there. The third one costs $80. The fourth one costs $160. The fifth one costs $200. The sixth one costs $240. The seventh one $280. $400. $560. And $680. Okay. And so that marginal cost curve usually looks kind of like a check mark. So remember why we make these tables and what we're going to use them for. Couple of things we want to make note of. First, we want to look at the minimum average total cost, and looks like this minimum is $320, and that $320 tells us the break-even price. If the market price this perfectly or purely competitive firm can sell their products for is bigger than $320, they're going to make a profit. If it's less than $320, they're going to lose money, and if it's equal to $320, they're breaking even, which isn't a bad thing. That means that they're satisfied. Average variable cost. The minimum average variable cost is $216 here. Let's highlight that. And that tells us the shutdown price. If the market price ever gets below $216, it is better for the firm to produce no units at all than to produce anything, because it's going to cost more for the labor and materials costs than they can sell each unit for. They're going to dig a bigger hole. Their loss is going to get bigger than if they just shut down and produce zero. And their loss would be $640 in that case. Revenue zero, costs $640. They'd lose $640. Now the next thing we always want to do is take this to the next level. This is what's happening with one small, purely competitive business. But in pure competition, there are a lot of small businesses all producing the same thing. And it makes sense to assume that most of these firms are going to be pretty similar. Now, in the real world, this isn't necessarily going to be totally true, but it's not a bad simplifying assumption to make so that we can say, if we have a lot of these firms, and they all have similar cost structures, as long as we can figure out how many firms there are, then we could figure out what the supply curve in this market might look like. So let's start, as I always do, by assuming that there are 100 small firms in this market, and let's draw the market supply curve. So I'm always going to assume we have a simple looking demand curve here. So that's what that blue line is. That's our demand. And our job is to draw what the market supply curve looks like. Now, how I always draw the market supply curve is I always start at the highest marginal cost, because how each individual firm uses this marginal cost curve is they ignore the downward sloping part of the marginal cost curve, and then if the market price is bigger than each of these marginal costs of each unit, they're going to produce those units, unless the market price is below the shutdown price of $216. So this marginal cost curve is kind of like the supply curve for each little individual firm. And if we have 100 firms, then the market supply curve over here on the right is just going to be how much each individual firm would produce at that price times 100. So I start at the highest marginal cost in the table, $680. And we know that if the market price was $680, each individual firm would want to produce 10 units. So if there were 100 little firms, each producing 10 units, all together at a market price of $680, they would produce 10 times 100 units, which is 1,000 units. The first point we want to draw on our market supply curve over here is a quantity of 1,000 and a price of $680 right over here, just a little below 700. And let's graph that point right about there. But what if the price got below $680? Well, each firm would not want to produce 10 units anymore, but as long as the price was $560 or higher, then each little firm would want to produce 9 units. So another point we can put on the market supply curve is at a price of $560, 560 would be over here. So 900 and 560, right about there. Okay, so we've got 2 points on our market supply curve, and we just keep on going. So the next marginal cost is $400. $400, 8 units. $400, 800 units if there are 100 firms. What if the market price was $280? Each firm would probably want to produce 7 units, so that'd be 700 units at $280. All right, so $280 over here, 700 units. Somewhere right around there. Okay. Now, $240, 600 units. All right, somewhere right around there. And our next marginal cost on our list is $200. So if the market price was $200, how many units would each of these firms want to produce? If we look over here, it says 5, but that's not the case. Why not? Why would we not see people producing 5 units if the market price was $200? Because of this shutdown price here. So the lowest price we can put on a market supply curve is the shutdown price. It just doesn't make sense to say that at any price below 216, anyone would produce anything. So instead of our last point, this is the lowest point we're going to put on the supply curve, instead of the last point being $200 and 5 units, we stop at the shutdown price. Now, if the market price was $216, yes, we would see each firm producing 5 units for a total of 500 units. So this last point, I'm going to put in a different color so that we remember that's the shutdown price. 216 and $500. Okay, so that's the shutdown price right there. And then if we wanted to be technical, we'd say at any price below that 216, we could draw this little purple bar over here, which would say at any of these prices between $0, $100, $200, all the way up to 216, we're going to see a quantity supplied in the market of 0. No firm would be willing to sell anything. But then as soon as the price gets to 216, we jump over here to this green point where each firm would be willing to produce 5 units, and then we kind of have a normal supply equals marginal cost curve from there on in. Okay, so now our last step that we want to do in the short run kind of analysis is to say, well, what does the market price look like it would be in this market today? Well, where the supply curve intersects the demand curve, it looks like that equilibrium price would be right around here. Price somewhere a little bit below $300 and a quantity of around 700 units. So around 700 units exchanged in the market, a price, right around this marginal cost. What was that point we plotted here? 700 units or 7 units per firm, $280. So from what I can see in this graph, that would be my guess. That the market price looks like it's around squiggly equals $280. We're not trying to be exact, but we're not trying to be sloppy here either when we do this. And the market quantity looks like it's somewhere around squiggly equals 700 units. So again, these are approximate answers. And in the real world, when economists do this kind of analysis, we know that we're getting approximate answers. And we want to make sure that we're clear to people who want our answers and want to understand what we're saying, that these are approximate predictions that we would be giving them. Why approximate? Well, because number one, we're assuming there are exactly 100 firms out there, and getting the number of firms in a market is harder than it might sound. We might look up the number of business licenses and find that there are 100, but maybe some of those aren't actually in business anymore. There might be some businesses who are practicing without a license. And so the number of firms, where we're multiplying those quantities times 100 to get the supply curve, that's approximate. The other reason why this is approximate is that we're assuming that all 100 firms' costs are exactly the same as this one firm's costs. And that's not going to be true in the real world. It might be approximately true, and so that means that these prices and quantities are going to be approximations when we're predicting this for an entire market. So what we're doing is not worthless, but it is giving us an approximate answer. All right, so let's talk more about what each firm would be doing. So in the market, we see the market price is 280, the market quantity is 700. That means that each individual firm would be producing 7 units. So the marginal cost of the 7th unit is the market price. They would go ahead and produce that. And what's going to happen to each little firm today if the market price is 280? Well, we see that market price of 280, it's above 216, so they will actually produce, but it's below 320, so they will be losing money today. Let's calculate how much money they will be losing. Their total revenue will be price 280 times quantity, 7 units each for each individual little firm. So that gives us $1,960 in total revenue. The total cost of these firms when they're producing 7 units is $2,240. So $2,240. And if we take $1,960 minus $2,240, each firm is going to be losing $280 today. So while in the short run, this would be our prediction, today their best choice is to go to work, produce 7 units each, lose $280, because their only alternative today would be to shut down and produce 0, and they would lose $640. So today doesn't look good. Now, what is going to change in the long run? Well, in the long run, if I have a business where I'm not able to cover all of my costs, this loss of $280 is not actually losing $280 the way you would think about it with an accountant. Remember, part of that fixed cost is how much the entrepreneur needs to be able to make in order to keep them interested in keeping this business open. What it means is when we take all of our costs, including the implicit costs, and one of those big implicit costs is going to be the normal profit the entrepreneur needs to be able to pay themselves, they're not able to cover all of those explicit and implicit costs. There's a $280 gap. And what that tells us is there's some other opportunity out there that this entrepreneur could use their resources, their land, their labor, their capital, and their entrepreneurship talents, where they could be making $280 more. So this $280 is compared to the next best thing, kind of like an opportunity cost, right? There's something else they could be doing better, $280 better. So in the long run, these firms are going to exit the industry, or some of these firms will start to exit the industry. And as they exit the industry, when we don't have 100 firms in the market, this supply curve is going to start to shift to the left. And the supply curve is going to shift to the left until we get to the break-even price, when entrepreneurs don't have a better opportunity out there. All right, let's shift to our Excel worksheet now, where we can see this happening in action. Okay, here's our Excel worksheet. So go to the tab that says Solved with Simulations down here. The other tab is the blank one that we were just filling out. And here we see the table all filled out and the questions that we already were talking about, that since when we filled out that table, the equilibrium price here of about $280 is below the break-even price of $320 here, that firms are going to start to exit the industry. So let's explore that. So the way I've created this Excel sheet is there are some numbers here that it says change the parameters below, and as you change these 4 numbers, you can see what would happen in the market. So the first thing I want to start with is changing the number of firms. In the long run, the theory is that if today firms are losing money, firms need to drop out, exit the industry until the market price gets to where firms are breaking even. So a market price of about $320. So let's see how many firms need to drop out. We started with 100 firms to get this red supply curve with this green shutdown price here. Let's change it to 95. What if 5 firms dropped out of the market? Did you see the supply curve shift there? You can hit Control Z and Control Y, and that will repeat what we just did, changing the number of firms from 100 to 95. Well, if we had 95 firms, what we're doing here is we're multiplying the quantity that each firm would produce times 95 to get the X values, the quantities here in the market. And that's going to shift the supply curve a little bit to the left. And here it looks like the equilibrium price is just a little bit above 300, maybe not quite up to 320 though. Let's zoom in here and see. I don't think I would call that 320 because this first gray line above 300 is going to be 325. So maybe we need to cause a few more firms to drop out of the market. Maybe get to 90 firms. Ooh, that looks like the equilibrium price is a little above that 325 mark. So maybe 93 firms? Hey, that's pretty close. So maybe if firms were losing money because the market price was below 320, maybe 7 of these 100 firms would drop out. And then we would be at the long run equilibrium, where there would be no reason for anything further to change because all the firms are breaking even. So no firms are going to enter, no firms would exit. Now, on the other hand, let's see what some other changes in the market could do here. Let's change the demand. So suppose we had these 93 firms and we were in long run equilibrium. All the firms are making $320 per unit. Their costs, including rewarding the entrepreneur that minimum amount, that normal profit, add up to $320 per unit. Let's suppose that this product became much more popular all of a sudden. So demand factor here, we can increase the demand to, 1.06 is what it says to change it to here. That's going to shift the demand to the right a little bit, right? What if we wanted to increase the demand even more? We could put in 1.2, right? And that would increase the demand a lot. Well, what happens in a market when we increase the demand? The equilibrium price goes up. So instead of an equilibrium price of 320 like we had a second ago, now the equilibrium price looks like it's a little above 425, maybe 430, 440. And the equilibrium quantity produced is going to go up. So this is consistent with what we learned when we were studying supply and demand. What else could we do here? Oh, well, since now the market price is above 320, firms are making profits. And what we want to happen is, here, let me bring up this little orange bar here so we can see. I'm moving this orange bar up to the minimum of the average total cost here, right? That $320. And anytime this equilibrium price is above $320, we're going to have entry. Anytime the equilibrium price is below 320, we're going to have firms exiting. So let's see what happens. After this product becomes more popular and the price goes up, we will see in the long run, over the next 3, 6 months, 9 months, it just depends how long it takes firms to organize and get into this industry, we're going to have more firms. Let's bring it back up to 100. Nope, that doesn't bring the equilibrium price down to 320. It still looks like it's 400. So maybe 110? Not enough. 120? Hey, that looks about right. So after the demand went up, this is going to give an incentive to more firms to enter, to where now if we have 120 firms, we'll get back to that long run equilibrium where we have productive efficiency. Each individual firm, each of these 120 firms, will be producing where their average total cost is at a minimum, the most efficient, cheapest way to produce, and we'll have just more firms in the industry now. Cool. All right, well, what could we change now? Let's change the demand back to the way it was, and let's change the number of firms back to 93 again, where everybody's breaking even again, and let's add an excise tax to these firms. So what I have in mind here is a per unit tax. It's like many states have on cigarettes. Every pack that is sold, the producer has to pay a tax to the government. So let's add, over here I suggest adding a $100 excise tax. So what's going to happen now is, in addition to paying their labor and paying their materials for every unit they produce, these firms will in addition have to pay another $100 to the government for every unit they produce. It's an additional $100 for each additional unit they produce. I want you to think about, in our cost table up here, what kinds of things are going to be changing and what kinds of things will stay the same. Is the fixed cost for this business going to change because of this excise tax? Remember, these are things that the business has to pay if they produce zero. If I produce no cigarettes, suppose these are very expensive cigarettes we're talking about here. If I produce no cigarettes, am I going to have to pay any of this tax to the government? No, then it's not a fixed cost. What about the variable cost? Is it going to affect the kinds of things we pay more for when we produce more units? Absolutely it is. And average fixed cost won't change. Average variable cost will. So average total cost must change because average fixed plus average variable equals average total cost. What's going to happen to the marginal cost? What's going to happen to the additional cost of producing an additional unit? Well, this first unit used to cost me $400 for the labor and materials. Now it's going to cost $400 for the labor and materials plus another $100 that I have to pay to the government in the tax. So when we add this excise tax, $100 in here, and we hit enter, let's watch what's going to happen. And we'll do it and undo it with Control Z on a Windows machine at least. So hit enter. So let's hit Control Z and let's see what changed. So Control Y, fixed cost didn't change like we said, Control Z, but the total cost changed over here. And the variable cost went up and the marginal cost went up by exactly $100 per unit there, right? What happens to the supply curve? The supply curve shifts to the left or decreases. Now what's really happening to the supply curve, since it's based on the marginal cost curve, is we're adding $100 to each of those prices on the supply curve compared to what they were before. So what happens when we add in the $100 per unit tax? What does it look like the new equilibrium price is now? If I had to guess, that looks like that's $325, $350, $375. Around $375, maybe slightly less. Now here's the key. The equilibrium price before the tax was $320. Now when we add in that tax, the equilibrium price is about $370. The tax of $100 does not increase the market price by $100. It increases it by something less. And this is an important lesson. When you add a tax to a product, consumers see part of that increase in price, but not the total $100. Firms end up eating some of that increase in cost. And let's look and see what effect this is going to have on these firms. The market price now is $370 or so. What's the new break-even price? $420. Used to be $320. So with a $100 tax like this, the break-even price for the firms will go up by $100. And if they were breaking even before, they're not going to be breaking even now. They're going to be losing money. So one of the interesting things about a tax like this is in the short run, we see the price go up by a portion of the tax. But then in the long run, what's going to happen is firms are going to drop out. And firms are going to have to drop out. Let's move this orange line up to the new break-even price of $420 there. Firms are going to have to drop out until we get to the new break-even price of $420. So as firms drop out, 90, 85, no, 80? All right, that looks about right. At about 80 firms, we went from 93 firms in the market who are breaking even. Now 13 firms are going to be put out of business, and we're going to be up to the new equilibrium long-run equilibrium price of $4.20 where firms are breaking even. So a tax like this has two effects. A short-run effect, where firms go from breaking even to losing money, and then a long-run effect, where some firms get put out of business and the price goes up even further so that firms can cover the entire cost of that tax. Now, the main reason why governments usually put in a tax like this is to give people the incentive to consume less. A tax like this on cigarettes or alcohol is usually called a sin tax. Smoking and alcohol are bad. The government wants you to use less of them, so we'll put a tax on it. And it's effective. We see here that instead of producing 700 units as we were before, now it's going to be about 600, or a little less than 600. All right, let's get rid of this excise tax. Let's go back to the 93 firms, and let's think about a different kind of tax that a government might put on some firms, a license fee. Now, think about a license fee like a beautician or a barber shop has to pay, or restaurants also have to have a license in order to do business in most places. A license fee is something that you pay, and then it doesn't go up. You don't have to pay a higher license fee as a barber cuts more people's hair, right? It's just you pay your license fee, and then that's it. Now, let's think about these license fees. If they're big enough, maybe the way that you finance this license fee is you borrow money from the bank. You pay your license fee, and then you pay a little bit back every day. Is this going to be a variable cost, where the more you produce, the more the license fee costs you, or is it going to be a fixed cost that you have to pay regardless of whether you produce or not? It's going to be a fixed cost. So if we put in a $1,000 license fee here, what's going to happen is our fixed costs will go up by 1,000. The variable costs won't be affected. Average fixed costs will go up. Average variable won't. What about the marginal cost? Because of this license fee, is it going to cost us more than it used to produce each additional unit or to cut another person's hair? No, the marginal costs won't be affected. All right, let's stop playing around and let's put in the license fee. And I want you to watch carefully at what happens here to the supply curve and what happens to these cost curves over here. And let's move our break-even price back down to $3.20. And let's see what happens. So license fee, $1,000. Hit enter. Undo it, redo it. Undo it, redo it. Undo it, redo it. What's the only thing that's changing? The average total cost is going up. The supply curve's not changing. Today, the average total cost is going up. So what's happened is our break-even price has gone up to around $450. If we look at our average total cost column here and find the minimum, we see it's actually $455. But the equilibrium price today is still going to be $3.20. So what's going to happen today is, hey, before this license fee, I was breaking even, and I was able to pay myself, the entrepreneur, that normal profit. But after this license fee, I'm losing a pile of money. In the short run, a license fee like this won't appear to have much of an effect to the consumer view. The price isn't going to change, the quantity isn't going to change, but to the business owners, they're going to be losing lots of money. So in the long run, we're going to have to see this supply curve decrease as firms drop out of the market. Maybe 80 firms? Nope, not enough. 70 firms? It still looks like that equilibrium is below, so 65 firms? That looks pretty close. So this license fee of $1,000 is going to drive 93 minus 65, about 28 of these firms out of business. Now let me give you an example of my favorite example of a license fee that is really big and has a huge effect on markets. If you Google New York City taxicab medallion, you see these little metal plates. And in New York City, if you're going to drive a cab, you have to buy one of these little metal plates and bolt it onto the hood of your car. And what this does is it gives you the right to drive that one car around and pick people up off the side of the street and drive them somewhere in New York City. Now, this is a really expensive investment. Guess how much it costs to buy one of these medallions? Well, it used to be a whole lot more than it is now, but now with companies like Uber and Lyft competing with taxis, these medallions are worth a whole lot less than they used to be. Let's look at a graph of how much these things are going for. So as we see here, in the 2008, 2009, 2013, these medallions went from being about 400, 600, 700,000 to over $1 million. And then when Uber and Lyft started competing, we see that the value, what people are willing to pay to get one of these medallions to be a taxi cab in New York City, has gone down about in half over the course of just about 3 or so years. Now let's think about the real cost of this. If you wanted to drive a cab, what are you going to do? Well, you're going to have to come up with, at least back in 2013 or 2014, you're going to have to come up with $1 million in order to buy that medallion. So let's type in $1 million here into Excel, and suppose you get a loan from the bank. Now, a business loan for something like a medallion, it depends on when we're talking about. But at a minimum, you're probably going to have to be paying something like 8% interest on that every year. So if we take 8% of that times 0.08, then that's $80,000 in interest you're going to have to pay every year. Now, how much is that per day? Well, $80,000 a year divided by 365 days, and that's about $219, $220 per day that a taxi cab owner must pay just for the interest on the medallion that they have to bolt to the front of their car. Now, you can sell these medallions. After you buy them, you can use them for 10 or 20 years, and then you can sell them to someone else. The problem is now people don't want these medallions as much as they used to, because now there is this new competition that these apps on phones have allowed to happen. So if you've ever ridden in a cab in New York City and the cab driver seems like they're kind of grumpy, now you understand why. A cab driver, or at least the owner of the cab, is having to pay $200 on just the interest for just the medallion. And then they have to start paying the driver. And then they start having to pay for gas and insurance and the car itself and the tires and the oil changes. And only after they have covered all that money can they actually start to make any profit, right? So this is an idea of a license fee that is a very substantial cost. And the purpose of this medallion, this license fee, is to limit the number of cabs in New York City. And this is one of the reasons why taxi cab companies are so loud and mad and mean about Uber and Lyft and these other companies competing with them. It is unfair in a certain way that these other companies did not have to fork over $1 million in order to get a medallion, and now they're doing much the same thing that cabs are allowed to do. So play around with this little simulation here. If you play around with it and it helps you to understand what changes in the short run, what changes in the long run, and how especially things like license fees, changes in demand, or taxes might change both the short run and the long run behavior of firms, you will really start to understand how these cost tables and the structure of costs in a business can impact both the individual businesses and the market as a whole. As always, if you have any questions about this, or if you have any ideas about other things that we might want to include in this simulation, please let me know. But otherwise, this is Dr. Berkey signing out. I wish you the best of luck with your studies, and I hope to see you next time. Bye-bye.